We start off with one heck of a tech wreck. The Nasdaq tanking today as investors hit the sell button on the growth trade. The index dropping 2.47% for its worst day since September. You're looking at the heat map of the Nasdaq 100. See lots of red there with Adobe, Skyworks, Xilinx leading the losses. And take a look at how the mighty have fallen. The big cap tech titans plunging in this pullback. Apple, Microsoft, Amazon all finishing the day firmly in the red. So what do you make of today's sharp sell-off? Is this a warning shot of more selling ahead, especially given the big rally? It was all party time yesterday, Guy. What happened?
Party in the, it's that Miley Cyrus song. By the way, I love Miley Cyrus. Party in the USA. Well, it was for a day. Look, I think people are starting to realize that maybe valuations in this environment, given all the rhetoric we've heard, not rhetoric, actually actual statements that we heard, people are starting to do the math and say, wait a second, maybe these names that we have talked about so often are not going to make sense early in 2022. But I'll submit this. Now's the time you have to start looking at levels to get back in some of these names. For example, Apple, and Dan said this, I've said it a number of times, Apple's an amazing company. But you've seen 20 to 35% peak to trough decline significant amount of times over the last 5 or 6 years. You might be on the precipice right now. I would say that previous all-time high, that September 7th all-time high of 157.25, I think that's where it's headed, and that's where you get back in. NVIDIA's down 18% in a month. You have to ask yourself, could you see a 25 to 30% move? Yes, you get back in that name at those levels. So it looks scary, and it should be, but there are levels that are going to make sense here very quickly.
Guy mentioned in this environment. Brian Kelly, what environment are we in exactly? If you took a look at yields, they were flat to lower today. It sort of didn't make any sense. It's sort of a head scratcher. If you think that tech is getting whacked because there's a fear of higher rates, yields didn't reflect that.
Well, there's a fear of higher rates because the Fed's going to raise rates, but there's also a fear of slower growth because the Fed's going to raise rates. So the Fed is in this really weird spot where they have to fight inflation on one hand, and the way that they usually do that is to put the economy into a recession. So if the Fed is actually really going to go through with it, and we saw the Bank of England today raise rates, the ECB came out, they basically did nothing. But if you're going to have central banks removing liquidity and trying to slow the economy down, then you have a growth scare. Therefore, longer end rates and frankly even 2-year rates really shouldn't go up that much. So, and we saw market PMIs today, flat. Year-over-year growth on those is 0. So the economy is slowing. Now add in the fact that they're starting to cancel shows and concerts and people aren't going back to work. The economy is slowing again. That's reflected in rates. It hasn't been reflected in equities until today.
It sounds like BK is saying that rates are in a box, so to speak, because, the growth fears, but then also pushed up higher potentially. It's sort of locked in there, right? Because the Fed will move, and yet there's fears about slowing growth. This is sort of like a Rorschach test, Tim, though, because the Fed is seeing hot growth ahead, and that's one reason why they have to raise rates. So if we are to believe that rates are in a box, isn't that benign to markets? Tim?
I'm sorry, I've been called on. Sorry, I didn't hear my name. So, look, I think it is, but I think you've got a case where there's also an argument here. And if you look at the way the small caps traded today, way the Russell traded, the dynamics in anything cyclical, look at retail was down 2.3%. You're getting sense here that people are concerned about growth, and that this to me is again a case of where maybe the Fed is going to move faster than they should because they were behind the curve. And so yesterday there was a little bit of a relief on that. But I would go back to the underperformance of both the semiconductors, a 4.4 move, basically took out all of yesterday's move and has you closed even all the way back to, say, about November 10th levels. But again, look at the triple Qs, look at the NASDAQ 100, down 4% relative to the S&P in the last 12 sessions. That's not a good sign. We've done the math. We've crunched the numbers. Those top 7 stocks, so I'm also adding in Tesla and NVIDIA on top of the big 5. That's 29% of the S&P, and we've talked for weeks, if not months, about the concerns around that.
Dan, what was your take on today's market action?
Well, Guy brought up Apple, and, we're talking about valuations, right? So we're seeing re-ratings here. We don't even have to talk about the high growth, unprofitable names that have just actually crashed this year. I mean, that's something that we've been talking about for months and months right now. So now we're talking about these mega cap names, the names that, Tim just mentioned here, and they've been the huge beneficiary of passive investing. And just think about Apple. It almost ticked $3 trillion in market cap early this week. That marked a 30% increase in just 2 months, okay? It's just unsustainable. And when you think about it, people say, well, that's value tech. You're telling me Apple, which was trading at like 30 times earnings that are only expected to grow next year 2% on 4% sales growth, that's value? I don't see it. And what I see is a whole heck of a lot of danger, because people are basically making the same assumptions about a Microsoft, about a Google. Why do you think that Amazon is only up 3% on the year and Apple's up 30%, Microsoft's up 40%, and Google is up 60%? Because Amazon's not considered value. But I got a little news flash for you. Either are those, unless the valuation frameworks have totally changed for as long as I've been doing this in 25 years. And I don't mean to sound salty about it. It just seems like yesterday's action was downright stupid, and today sounds downright reasonable when you consider what the Fed, to BK's point, may have to do, right, to kind of fight this inflation. And they will choke off growth. But I'm telling you this, the Fed got themselves so turned around because Jay Powell, as Guy has said on the show the other night, top-ticked this whole thing. I don't care what he thought transitory meant. At some point, inflation will be much lower. The bottlenecks that caused a lot of this inflation, the black swan pandemic that nobody saw coming and nobody knows how long it's going to last, because I guess it's still going on, right? At some point, inflation will come back. And pre-pandemic, the Fed was wrestling with how to get inflation to 2%. Up to 2%. You know what I mean? So it's going back there. I just think it's a bit goofy. And I think the fact of the matter is the broad market and these generals could use a little breather.
I like this, Dan. He's not meaning to sound salty. He is salty. He is salty tonight. See, the thing is that people wanted to turn the framework, the value framework, on its head in this environment, BK. How many times have we heard people come on this network saying that big cap tech is going to be your friend in good times and in bad, right? That's the trade, and it's value, and it's going to be good for you. And when the economy slows down, it's good for you. When the economy's hot, it's good for you. It's win, win, win. And here we are. What's the deal in your view?
Yeah, the most dangerous words in investing is this time it's different. It's not different this time. And people at near tops and near inflection points tend to start to change the rules of investing and say, we saw it back in the tech bubble in the late 90s, okay? We thought there was no profitability, but we said, oh, no, the internet's it's going to grow exponentially and they're going to get profitability eventually. So that's the same thing that's happening here. People get ahead of themselves. Analysts get ahead of themselves. And frankly, professional investors often get ahead of themselves and look to craft a narrative around what's happening. But when you actually do get some real growth scare and some real economic decline, then the fundamentals actually really do matter. And that all changes. And I think that's the environment we're in here, where you have the Federal Reserve that'll be raising rates at the exact wrong time. And I agree with Dan and Guy. The fact that the Fed has taken the word transitory out probably means that that's the peak in inflation.
What kind of re-rating are we talking about for big cap technology in particular? I mean, you take a look at, in Apple, it's 5.5% from its 52-week high. Alphabet is off 4%. Microsoft is off 7%. These aren't tremendous moves from all-time and or 52-week highs, Guy. What does a re-rating look like in your view?
18 to 25, and people will be like, oh, you're out of your mind. Well, I'm not. Well, maybe I am, but I'm not in terms of this, because we've seen it a number of times before. And by the way, the names you're talking about haven't reached that, but look at some of these other names that are not micro cap names. You're talking about market caps of anywhere from $30 to $100 billion, and you've seen moves anywhere from 35 to 60% to the downside. So I think to Dan's point about, they get the generals last, that's a Carter Braxton Worth thing. Well, they might be coming for him now, and you got to have your levels ready. And in terms of Apple, I mentioned 157.25, and when Nvidia gets down 25%, down 18% now from its recent high, I think you step in there, but you got to be ready because it happens really fast.
Tim, are you as worried about the Fed choking off growth, and in that environment, what do you buy?
Well, I'm certainly not as salty as salty Dan, but I do think there's an environment where we've seen the Fed in the past go from 0 to 60 on rates and overstep their bounds too. I mean, this is the analog from 2018. I actually just think some of this is a function exactly of what you said of where we're coming from. That a 5 to 10% correction in any of these stocks is not bad. It's probably healthy. Speculating on what the multiple should be in these stocks. What is different this time is that rates are truly at zero. And therefore, these stocks should be trading as a function of where rates at zero should be. In other words, at premiums that they don't deserve. Rates are not going to move that aggressively. I don't think there's any way that they can. And right now, I know we're at 3 next year and 3 in 23 and 2 in 24. But I'm still not sure we're going to get there, even though, like the rest of the fellows here, I acknowledge that the Fed is behind the curve and we have inflation. So I guess, I'm not willing to say that it's all coming tumbling down. I'm willing to say, let's look at key levels here. I'm more worried about 7 stocks being 29% of the S&P, no longer just talking about the NASDAQ 100. This is the market we're talking about. And I think the market's had such a big run that I do think we can correct. But I don't think that, 18 to 25 on a multiple, that's scary stuff.